Will the SBI Life Smart Lifetime Saver Plan aid you in fulfilling your financial aspirations in the long run? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So this is a individual non-linked participating whole life insurance savings product. Some of the key features of the policy are it gives you life cover till the age of 100 and you have a choice of 3 premium payment terms like 10, 12 and 15 years, and there is lump sum maturity benefit available, which is the total annualized premiums payable under this policy. And you also have guaranteed survival income, which starts from the end of your premium payment term. And there are additional non-guaranteed survival income like cash bonus, if declared, will be available starting from the end of your 7 policy years. And there is option to accumulate the survival incomes, and there are also 2 optional riders available in this policy. So these are some of the key features, and there are benefits like survival income, maturity benefit and death benefit. So there are 2 kinds of survival income. One is guaranteed survival income and other is non-guaranteed survival income, which is the cash bonus. If you want to know more about it in detail, you can refer to the policy brochure. Now let's take a look into the advantages. So the advantages are your premium paying term and premium paying frequency can be chosen as per your convenience. The death benefit is available throughout the policy term, that is till the age of 100 years. There is flexibility to accumulate your survival income and you can also withdraw it at any time during the policy term. And there is tax benefit as per section 80C, and there is a maximum of 50% of the surrender value which can be availed as a loan option. So these are advantages. The disadvantages are the survival benefit has both guaranteed and non-guaranteed components, so you cannot earmark any of your expenses. Though this policy offers protection for the whole life, the life cover is inadequate. The survival income, which is the guaranteed benefit, is reduced after a gap of every 30 years till maturity, and any survival income there is should be increased to adjust to inflation, but here it works in reverse. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let's move on to the analysis part of the video, where we are going to calculate the internal rate of return (IRR) of this policy based on the figures given in the policy brochure, and later on we can conduct a comparative analysis with other investment products returns with just to see what is the better alternative and what can give us better return in the long run. So for calculation purpose, let us assume that a 45-year-old male buys this policy with a 15-year premium paying term. The annual premium is 3 lakhs. The non-guaranteed benefit starts at the end of the 7th year. The guaranteed benefit starts after the premium paying term. So let's work out the IRR for this cash flow. The non-guaranteed benefit depends on the bonus rate declared each year. That's where we are going to assume the future rate of returns at 4% per annum and 8% per annum to calculate the benefits. Because just to give you an idea of how this policy can work under worst case scenario like 4% per annum and best case scenario like 8% per annum. But the bonus rates are assumed constant during the bonus accrual period, whereas the actual bonus could vary depending on the investment experience of the company. If the policyholder survives for 100 years, the maturity benefit is payable. So the IRR under the 4% scenario is 3.52% and the IRR under the 8% scenario is 6.36%. These rates are calculated after considering the maturity benefit at the end of 100 years of age. So these returns in reality are not beneficial when considering a long-term investment. Though you may receive a regular income, the amount may vary every year because it it is assumed as a consistent amount, but that's not the case in reality. So this might affect your plans. Investing in this policy might not be beneficial in terms of returns and also in terms of inconsistent survival amount. So under this policy, in the initial years we accumulate our savings and later we receive regular survival benefits. Similarly, we can also choose some other investment vehicle to accumulate savings and invest the accumulated corpus to withdraw money regularly. Also, we can assume a life cover for a sum assured of 50 lakhs because in the previous example, the sum assured is around 49 lakhs. So the premium for a life cover of 50 lakhs would cost 16,400 rupees for a 15-year premium paying term, which is the regular pay. So in the previous example, the annual premium was 3 lakhs. So the balance amount we pay after the premium can utilize for investment, because now we are going to separately invest in insurance and investment, and we are going to use the same premium that we used to pay for SBI policy here by allocating it efficiently across insurance and investments separately. As the accumulated corpus through investments will take care of your post-retirement needs, the life coverage is assumed till 60 years. So we have taken up a pure term life insurance policy for life coverage. The cash bonus starts yearly in the SBI life policy. However, the guaranteed survival benefit starts after the end of the premium paying term. So for this comparison, annual withdrawal starts after the end of the premium paying term. After paying the premium for pure term insurance policy, the remaining amount is utilized for PPF or ELSS investment in the initial 15 years. The maximum annual contribution to PPF account is 1,50,000 rupees. But here we assume that the balance amount is invested in the PPF account just for comparison purpose. The ELSS maturity proceeds are subject to capital gains tax. So here we have considered a tax for the same. So the IRR is a post-tax IRR. In the initial 15 years, the savings are invested in either PPF or ELSS as per your choice. Later on, the accumulated fund from the respective investment in 7% return investment to have a regular cash flow similar to the above example, like in this SBI policy. So at the 8% scenario, the annual survival benefit was 3,04,500 rupees in the SBI policy. So the same is assumed to be withdrawn in here in this scenario from the 7% return investment. So after withdrawing till the age of 100, the final corpus is going to be included in the IRR calculation. So here the accumulated corpus value under PPF is 76.91 lakhs. Under ELSS it is 1.18 crores. This is pre-tax value. The post-tax value is 1.09 crores. So the accumulated corpus is invested in a 7% return investment for regular withdrawal. If you have any doubts regarding how the ELSS tax is calculated, we do have a separate small tabular column presented on the screen for your reference, which you can pause and see. So after withdrawing regularly, you are left with an ample amount of money at the age of 100. In the SBI policy, the maturity value under both scenarios, like maybe it could be 4% or it could be 8%, is around only 95 lakhs to 1.3 crores. But here the final corpus value is 5.01 crores in PPF and 9.83 crores in ELSS, which is almost 5 times and 10 times even higher. So the IRR for pure term and PPF combination is 6.85% and pure term and ELSS combination is 7.88%. These rates are far better than the SBI policy. Also, you have liquidity in these investments. So either you can utilize the corpus for any of your financial goals or shift your funds to better yielding products in the long run. So what is the final verdict on the SBI Life Smart Lifetime Saver Plan? Is it worth investing or not? This policy offers survival benefit every year after the end of the premium paying term and also provides lump sum maturity benefit at the end of 100 years. All these benefits include both guaranteed and non-guaranteed portions. The IRR for a long-term investment should be higher than the inflation rate. Here, the IRR is lower than the inflation rate. So investing in the SBI Life Smart Lifetime Saver Plan is not a good option to get regular cash flow. In general, having life cover till your working age is enough, or sometimes you may extend till you meet most of your financial goals and pay off your liabilities if any, but during the post-retirement period. effective investment of accumulated retirement corpus, an emergency kitty, and health insurance is more than enough. A whole life policy doesn't give you any value addition to your retirement plan, even if it offers a survival benefit. So, do consult your financial advisor and draft a retirement plan that will suit your ideal retirement life you have imagined.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.